Hey, welcome back. Happy holidays. Happy to have you here. As we head into the holiday season with Christmas and New Year's around the corner, I want to take a moment to reassess the world as we see it today, some of the geopolitical and economic tensions we see, and how we can potentially profit off those if we truly understand why some of these things are happening and what really makes them tick. This will not be a political statement. This will not be around the political agenda of either party, whether in the United States or any of its outlying allies. One of the first things I want to go over, though, is how do we actually turn a crisis into cash? If we understand first what some of these crises look like, we can better predict them. You'll see here, these are some of the 5 most expensive corporate, and these are corporate crises and their lessons. So number one is, and some of you may not be old enough to remember, the BP Deepwater Horizon oil leak. And I promise we're going to go through some of these, then I'm going to teach you how to profit off of each one of them based on how you need to invest, and we're going to go over some risk assessment and diversification strategies. So back here to number one, the Horizon oil leak. It was a $70 billion cleanup. There were fines. There were obviously reputational damage. So the big lesson there was create a safety culture for BP. But as an investor, what can you do? Well, as soon as you see an oil spill or an oil leak, what would you do? I mean, what do you think you should do? Well, I can tell you right now, an oil leak, an oil spill is going to have PR damage, and you're going to see reputational damage. You're also going to see a drop. You're going to see a decline in the stock. So the stock's going to go down, which means you could potentially pick some up and make some money. Number 2, Wells Fargo, the sales practices scandal. Wells Fargo was opening accounts for people that didn't exist, or they were opening 6, 7, 8, 9, 10, 11, 12 accounts, whatever that may be. That's obviously illegal. That's fraud. So they had to pay a $7 billion fine and regulatory settlement. And the lesson here is live up to your values. Well, as you see Wells Fargo doing stuff like that, you may actually want to get rid of the stock. You may want to walk away in order to save yourself some money. Maybe that's not something you believe from an ethics standpoint you want to be involved in, or maybe you foresee future issues there that you want to stay away from. The third one is the JP Morgan financial exposure. So they had investment losses of just about $6.5 billion. This is where they had some data leakage, and they had PII data that had leaked, but the C-suite here needs to stay on top of risk. So in this case, how can you profit off this? Well, as a financial or a data breach sends stock down, you may be able to pick some up at a lower price, therefore increasing or lowering your cost basis. Number 4, the Facebook, the user privacy scandal. This was several years ago. I want to say it was 6 or 7 years ago, maybe 2015, 2016, where they were selling out more than they normally do, selling out user privacy data. They ended up getting hit with a $5 billion fine, of course, to a company that's worth $500 billion. That doesn't really make a whole lot of sense or doesn't really do anything to them. One thing you can do here to profit off this is you can potentially buy more Facebook as the price is low, or you could sell calls and make money when it goes down. And finally, and this is by no means in any particular order, the Equifax data breach. They had data breaches from Equifax as a credit lending and scoring agency. So they had data breach issues, they had fines, they have $1.7 billion in fines, and they need to take crisis prevention and planning seriously. So again, when these companies have down days or down incidents like this, how do you profit off that? Same thing, you could buy it low and then sell it higher. Now, let's flip over here. This is an article that I found from Bain that I really like. It talks about investing in a time of crisis and what that actually looks like. Now, I'm gonna link this article down below, but the first thing I want you to look at is investments made during the 2008-2009 financial crisis typically resulted in strong returns. So while you actually had lower returns here in 2007, 2008, 2009 during the housing crisis and the housing subprime mortgage crisis of 2008, 2009. As things went on, you went from an 8% return to a 28 to a 19. But as the equity pools went down, the returns year to date started to go up during and after, while a lot of people thought they would crash. Much like today, you're hearing Goldman, you're hearing Morgan Stanley, you're hearing UBS continue to talk about how there's a recession around the corner. Well, had you listened to them this year, you would have lost out in over a 26% 20 to 26% gain on the S&P 500, the Russell, and the Dow. This year has been crazy, and I hope you've continued to invest. But this article goes back and talks about, this is from April 2nd, 2020, of what it's like during COVID and what we need to do when we open back up and what the markets will look like. One thing that it talks about is there'll be artificially suppressed demand for goods and services. Industries will bounce back, but industries will recover in different ways. And this is, again, where you can continue to profit. So they talk about demand is suppressed during outbreak, remains a declining trend. So if you're a company you're looking at or a country you're looking at already had problems before an outbreak or before a global disaster, they're probably going to continue to have issues. Case in point, the United States. Debt before COVID-19 was around $19-20 trillion. Between the time of COVID in 2020 to now, I think we're at 33 or 34 trillion. We've printed over half the money in circulation in the last 4 years. That's not good. That's not good no matter how you slice it. Debt is not a problem if it's the right debt, but we're going to soon, if not already, the United States will be paying more in interest than it ever has before, and we're getting to a point where we're not going to be able to pay off our debt. We're only going to be paying interest. That's another video. But it talks about a short-term hit, a long-term tailwind, a short-term hit, a long-term recovery. So demand slowly recovers to pre-COVID-19 levels, but long-term trajectory generally unchanged. Tourism, commercial construction, restaurant, food services. Yeah, so during COVID, if you wanted to profit off that, off a global pandemic, you could have shorted things like tourism. So Disney could have shorted things like AMC, whether it's the movie theaters. You could have shorted retail sector or retailers. So think JCPenney, Kohl's, something like that. You could have shorted. As we go into step 3, you have a short-term hit here. You have a bounce back. So people that were not buying things like automotive, luxury goods, retail health, pharmaceutical, trials, those things start to bounce back. You have a short-term spike and a long-term decline. So grocery stores, the second to last stages, you have a long-term stability. So that could be skilled nursing, at-home exercise equipment. I saw a lot of Peloton, Tonal, I think there was another one, spike during COVID as the at-home exercise equipment market boomed, and I was one of those that purchased a Peloton and a Tonal. By the way, I actually love them. If they want to sponsor, please get in contact with me. Cable television streaming, obviously Netflix has done extremely well. And then we've got a short-term spike with long-term growth, where it's home health, online pharmacy. Now, this article does talk about COVID-19, or is it something else? It could be, it could be a natural disaster, it could be a war, it could be another it could be a famine, it could be a global overpopulation, etc. But I'll make sure and link this down here. I think they did a great job. All right, so we've talked about some of the global issues and what that looks like. But how do you go about and how do you profit from it? Well, one of the things you can do, the first thing you can do when it comes to diversification and profiting is you can use ETFs as a safe haven. ETFs are exchange traded funds. I've talked about it on this channel before, but they're known for offering diversification and stability in volatile times. So some of the ETFs that I've looked at are a lot of Vanguard funds. I think VTI, VTO, VWE, VEA. Those are all great ones that help that have done well during past economic downturns, and they offer a great choice. Now, here, if you look, this is the U.S. equity net flows index of what it's looked like over the last 30 years. If I look here, I can see we're down here. The inflows were. Let me change my marker here. There we go. The inflows down here, net inflows were at around negative 60 billion. As we started to go up, we had the dot-com bust here. We can see the flow of money in this yellow or orange, as you say, is continually going up here. But we can actually see what the net flows look like from the green or from the blue. And then, the orange is the S&P price index. So, like I said, we've seen what they'll do, what the price index does here. This is the dot-com bust right here. Obviously, things went down. We saw things go up, and then lo and behold, right here, we had the housing crisis. And if you look right here, this is one of the biggest crises that the world's ever seen financially was right here. Pensions, 401ks, housing prices all just got completely decimated right here. But look what happened. Notice anything? So had you bought in here or here or here or here or here, you've made money. And that was 2009 And this only goes up to 2020. Guess what it's done since then? It's went from right, let me move this right here, and it's went all the way up. So again, all you had to do in this case was buy ETFs, some of the ones I mentioned, and it's went up, 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 up. However, we've seen a lot of people in 2020 have to take money out of the market. So there was net outflows into the market right here, where people needed to take money out for obvious reasons, to pay for bills, etc. So that's the first way you can use ETFs as a safe haven during a crisis in order to pad your cash cushion, or to put some gains on the table. The next one is real estate. So real estate's always been considered a safe bet during economic instability, much like gold has. We're going to look at, I've talked on this channel a couple different ways through real estate. I'll make sure to link those down below, or I'll put them up here. I'll have my editors put them up here. And these are great from a real estate perspective, whether it's a REIT or you want to buy property directly. Here's a chart that goes year-over-year growth in investor purchases from real estate. This is a national level of the United States. As you'll see back here, 2000, we had the dot-com bust here. We don't really have any data. We see people started buying more real estate here. They started buying more real estate here. What happened right here? Well, this is when they started issuing subprime loans to people with 560 FICO scores, no income, no job, and no assets. And guess what happened? A lot went back on the market. We recovered from that. Things went back up, back up, back up. Great. They went down just a little bit as prices got a little too high. Then they started to go back up, 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 and then boom, what happened here? Well, we had another economic and global impact of COVID-19 happened right there. And COVID-19 sent inventory, actually says right here, they declare COVID-19 a pandemic. This was in Q1 of 2020. I'll never forget where I was then. It's another good story I'll save for another time. And what happened? Prices went through the roof because there was perceived lack of inventory. No one knew what to do. A lot of people were stuck at home, and they moved out of those higher priced cities. Maybe they moved out in the country. Maybe they moved to a state with no income tax, whatever that may be. Housing prices went crazy. And guess what's happened since then? Housing prices have now started to, see if I can get this right. Housing prices have now started to retreat and go down 45% as of Q2 of 2023. I know we're in Q4, but this is Redfin data from across the country. Now, in this case, you would want to actually start buying here. This is exactly where you want to buy if you want to start making money. There's pretty much, outside of a few metro areas in the United States, there's very few places that have not seen price reductions. So real estate could be another place to put some money if you want to, garner some returns and turn some of that cash from that crisis into cash. The next one is Bitcoin and crypto. And I've talked about crypto several times on this channel. I have an entire playlist, an entire series on crypto. So don't forget to check that out. But we talk about the correlation of what gold and silver can do when it comes to a crisis, just like real estate or even ETFs. Crypto, and I'm specifically going to talk about Bitcoin here. Bitcoin has done very, very well in terms of price correlation and the overall price appreciation of Bitcoin. So in this case, Bitcoin is here. It's got a lot more volatility than what the S&P 500 will do, but you'll see here, it kind of moves in lockstep. As we see right here, this was COVID-19. This was COVID-19, this dip here. This is an S&P 500 index fund, but you'll see it started to go up, and then look what happened. As it started to move up, we saw this here. And right here was when the Fed and the government started pumping a ton of money. It was right around the time that Joe Biden ended up going into the White House. So right here was when a lot of money got pumped in and Bitcoin just skyrocketed. Now, if you want less volatility, an S&P 500 index fund could be something, again, you could also invest in. But if you just bought Bitcoin here, Bitcoin's up, let's see. So we've got Bitcoin at 10. Bitcoin is 50,000 up to almost 70,000. And then you've got the S&P 500 index fund almost at 5,000. So again, another great correlation you're seeing there between an index fund and crypto. But if you're looking to turn a massive crisis like something with COVID-19, which I'm not saying you should, but if you wanted to, again, the topic of this video is how to profit. Bitcoin, Ethereum, and then you also look at the correlation between Bitcoin returns and the S&P 500 index. Right here, we talk about COVID. This is probably about right here is when COVID, and then look what happened. Boom. And then the higher this goes right here, the greater price correlation you have. So right there wasn't a lot of correlation here, but up and through here, you're seeing a lot of correlation between the two. So something to keep in mind. Okay, this is another, we're going to move, now that we've talked about a couple different ways to profit, we're going to actually go into the last one, which is risk management and diversification. And this is the importance of not putting all your eggs in one basket. Diversifying your investments and having a solid risk management strategy is very important to protecting your portfolio during a crisis. So as we know, there we go. Diversification reduces risk. In this case, if you wanted to, you could profit from all three ways I just gave you. So you could go into ETFs, you could go into real estate, and you could go into crypto. You could use all three, you could use one, you could use two. The point is, start diversifying. Number two, the diversification enhances returns. Of course, we've seen massive returns from Bitcoin. We've seen good returns from the S&P 500 this year. I want to say we're at about 23% on an S&P 500 index fund. So nothing wrong with that. Definitely hedged off inflation, and it's you can pocket some dividends. Diversification should be tailored. Yeah, of course. So if you're not comfortable with crypto, don't buy into it. Just, stay away from it. Or again, go back to point number 1 and 2, reduce your risk, enhance your chances of returns. Maybe you put 10% to crypto, 50 to stock, 40 to real estate. And the last one is, it does require discipline. So if I go back to one of these charts, let me find it here. I think it was this Bitcoin one. Yeah. So if you look here, Bitcoin, let's see, here's the price right here. If you are not comfortable with dips right here and right here, don't buy Bitcoin. You need to have discipline. You need to make sure that crypto is a long-term strategy. Think 20 years out. So these tiny little blips here that we see on the screen where, you see a crash or a little bit of a drop here. I wouldn't say a crash, but a drop here. And then of course, these right here, those, if you're not okay with those, don't buy it. End of story. Leave it alone. Okay. I'm going to link another one of these articles. This is around stagflation, which is another topic I'll probably get into. And then I'll put a couple of these other articles that I think are great. So with that being said, how are you diversifying? How are you profiting off a crisis, whether it's famine, COVID, another a pandemic? It could be a financial crisis, which I'm sure we'll have another one of those. It could be a housing crisis. It could be a famine, whatever that is. Let me know how you're profiting. Did you find this video informational? Let me know what you like. If you're investing in any of the ways I told you, please let me know. And as always, don't forget to design your financial freedom. Take care and a happy holidays. Bye-bye.